There is a reason this is called a secret, and the reason is not that the information is hidden in some vault accessible only to the wealthy, or the connected, or the professionally trained. The information is public. It has always been public. It sits in annual reports and academic research papers, and the historical record of market returns stretching back over a century, available to anyone with the time and the genuine curiosity to look at it seriously. The reason it functions as a secret, the reason the majority of people who participate in financial markets either don't know it or know it intellectually but don't act on it, is that the secret is psychologically uncomfortable, commercially inconvenient for the industry that profits from complexity, and fundamentally at odds with the story that most people tell themselves about why they are in the market and what they are trying to achieve. A secret that is hidden in plain sight, protected not by locks or restricted access, but by the simple fact that almost nobody wants to believe it, is in many ways more durable than one that is actively concealed, because the active concealment can be broken. The psychological resistance that keeps people from accepting something they don't want to be true is far harder to dismantle. So the secret will be stated plainly, and then the rest of this will be dedicated to building the complete picture of why it is true, what it means in practice, and what actually changes when a person genuinely accepts it rather than just nodding at it on the way to doing exactly what they were going to do anyway. The secret is this: the single most powerful force in wealth building through the stock market is not intelligence, not superior analysis, not access to better information, not timing, not the ability to identify the next great company before anyone else does, not a proprietary strategy, not a particular indicator or system or approach. It is time, combined with the behavioral discipline to let time do its work without interference. That is the entire secret. The investor who buys a broadly diversified portfolio of quality businesses at reasonable prices, contributes to it consistently regardless of what the market is doing, and then leaves it alone for decades will, with overwhelming statistical probability, outperform the vast majority of active participants who are spending enormous amounts of time, energy, and transaction costs trying to outsmart a market that has already incorporated the best available information into its prices. Not because the long-term investor is smarter, because the long-term investor is not actively working against themselves in the ways that almost everyone else is. The reason this is a secret is what surrounds it. What surrounds it is an entire industry built on the premise that doing more, trading more, analyzing more, adjusting more, switching strategies more frequently, following more sophisticated approaches, all of this activity produces better results than patient, boring, long-term ownership. This premise is commercially necessary for the industry, because the industry generates revenue from activity. Every trade produces a commission or a spread. Every fund charges management fees that are justified by the active decisions being made on behalf of investors. Every course, every subscription service, every advisory relationship is sold on the premise that the person or system being paid for knows something about the market's future direction that justifies the cost. If the truth, that activity generally destroys returns and that passive, patient, long-term ownership generally outperforms, were widely accepted and acted upon, an enormous portion of the financial services industry would lose its commercial justification. This is not a conspiracy. Nobody is sitting in a room deciding to hide information from the public. It is simply the natural result of an industry's economic incentives shaping the information it produces, the narratives it promotes, and the behavior it encourages in its customers. The evidence for the secret is so overwhelming that engaging with it honestly should settle the question for anyone willing to look. Study after study across multiple decades, across multiple countries, across different asset classes and market environments, has shown that the majority of actively managed funds run by professional investors with access to extensive research resources, proprietary data, teams of analysts, and every tool that modern financial technology provides, underperform their benchmark indices over periods of 10 years or more. The numbers vary slightly depending on the time period and market studied, but the general finding is consistent. Somewhere between 70 and 90% of active funds fail to match the returns of a simple index fund tracking the same market over a decade or longer. These are professionals with every resource advantage imaginable, failing to beat a strategy that requires no analysis, no research, no timing decisions, and no active management whatsoever. The implication for individual retail investors, who have fewer resources, less information, higher transaction costs as a percentage of their portfolios, and the additional psychological burden of managing their own emotional responses to market volatility without institutional support structures. The implication is not encouraging for the case that active management and frequent trading produces better results. Understanding why active management consistently underperforms is more useful than simply accepting that it does, because the reasons illuminate the specific mechanisms through which returns are destroyed, and recognizing those mechanisms makes it possible to avoid them. The first reason is cost. Every active decision in the market has a cost. Commissions on transactions, bid-ask spreads, the price impact of large orders, taxes on realized gains. These costs accumulate continuously and compound over time in the same way that investment returns compound over time, except in reverse. A fund or individual investor incurring 2% annually in total costs needs to outperform the market by 2% every year just to match the net return of a low-cost index fund that incurs almost no costs. 2% sounds small. Over 20 years, the difference between a portfolio compounding at 8% annually and one compounding at 6% annually is not small. The lower-cost portfolio ends up with nearly 80% more money at the end of the period. The costs that felt insignificant year by year have consumed a staggering portion of the potential wealth over the full-time horizon. The second reason is the practical difficulty of consistently generating alpha returns above the market benchmark in an environment where prices reflect the collective judgment of millions of sophisticated participants. The efficient market hypothesis, in its various forms, makes the case that market prices, at any given moment, already incorporate all publicly available information, which means that finding a genuine informational edge, knowing something that the market doesn't already know, and that isn't reflected in the current price, is extremely difficult and becoming more difficult as computational power, data availability, and the sophistication of market participants all increase over time. This doesn't mean markets are perfectly efficient at all times. Behavioral research has documented persistent patterns of mispricing driven by investor psychology that offer potential edges to patient, disciplined investors. But those edges are narrow. They require significant patience and discipline to exploit, and they are far less accessible than the financial media suggests when it presents market analysis as a tractable problem that anyone can solve with the right tools. The third reason, and in practice the most powerful one, is behavior. The gap between the returns that investment strategies produce in theory and the returns that investors actually capture from those strategies in practice is one of the most consistently documented phenomena in behavioral finance. And it is consistently negative, meaning investors reliably capture less than the strategies they are invested in produce. The mechanism is straightforward. When markets are rising and sentiment is optimistic, capital flows into the market. New investors enter. Existing investors increase their allocations. Risk tolerance appears to expand because recent experience has been positive. When markets are falling and sentiment is fearful, capital flows out of the market. Investors sell, reduce allocations, decide that the risk is too great, that something fundamental has changed, that this time is different from previous declines. The aggregate result of this pattern, buying after prices have risen and selling after prices have fallen, is that the average investor buys high and sells low, which is the precise inverse of what is required to generate returns. Not occasionally, not in isolated instances, but as a systematic, repeated pattern that shows up in the data across different time periods and different investor populations with remarkable consistency. The behavioral gap is not a reflection of stupidity. It is a reflection of the way the human brain processes financial risk, which is not aligned with what rational wealth accumulation in financial markets actually requires. The brain that evolved to respond to immediate threats by acting quickly, that uses recent experience as the primary input for evaluating future risk, that finds losses approximately twice as painful as equivalent gains are pleasurable. This brain is poorly suited to the patient, counter-intuitive behavior that long-term market participation demands. Acting quickly is the wrong response to market volatility. Using recent experience as the primary guide to future risk leads to excessive optimism at market peaks and excessive pessimism at market troughs. The asymmetric pain of losses versus gains makes selling at the worst moments psychologically appealing in a way that is almost impossible to resist without a prior framework that overrides the emotional response with a predetermined rule. The secret, then, is not just that time and patience create wealth in the stock market. It is that time and patience create wealth specifically because they are the antidote to the behavioral destruction that erodes the returns of almost everyone who tries to do something more sophisticated. The investor who is doing nothing, who is holding a diversified portfolio and contributing to it regularly, and refusing to make reactive decisions based on market movements, is not succeeding because of a lack of sophistication. They are succeeding because they have removed the primary source of underperformance, which is the active decision making that is supposed to add value and instead reliably subtracts it. Compounding is the mathematical mechanism through which this patience generates wealth, and it deserves a more detailed examination than it typically receives because most descriptions of compounding present the numbers without conveying the actual experience of what compounding feels like across a long time horizon. And the experience is crucial to understanding why so many people abandon the strategy before its power becomes visible. In the early years of compounding, the results are modest. An investment growing at 10% annually doubles in roughly 7 years. After year 1, it is 11% larger. After year 3, it is 33% larger. These are real gains, but they don't feel transformative. They don't produce the visceral excitement that a well-timed trade produces. They don't generate stories worth telling at social gatherings. They accumulate quietly, invisibly, in a way that requires faith in a mathematical process that the emotional self finds deeply unsatisfying. And during those early years, the market will also produce downturns that temporarily reduce the account value, reinforcing the feeling that patience is not working, when in fact what is happening is completely consistent with what a long-term compounding strategy looks like during its early stages. The transformation happens gradually and then suddenly. By year 10 or 15, the base that is compounding has grown large enough that a single year's return is a significant absolute amount. By year 20 or 25, the portfolio has reached a size that would have seemed extraordinary at the beginning of the journey, and the annual gains are larger in absolute terms than the total amount invested in the early years. By year 30 or 40, the numbers produce the kind of outcomes that get quoted in financial literacy examples and dismissed as unrealistic by people who have never experienced the full arc of compounding because they interrupted it somewhere in the middle. The interruptions are where the wealth is lost. Not in the market, not in any particular investment decision. In the decision to stop, to switch, to react, to abandon the boring, patient approach in favor of something that promises faster results and delivers instead a reset of the compounding clock to zero. One of the most counterintuitive implications of this understanding is the relationship between market declines and long-term wealth creation. For an investor who is still accumulating, who is contributing regularly to a portfolio and has a time horizon of 10, 20, or 30 years, a market decline is not simply a loss to be endured. It is a period during which new contributions and reinvested dividends purchase more shares at lower prices, which increases the future value of the portfolio when prices recover. The investor who contributes the same monthly amount during a severe market decline and for the years immediately following it ends up owning significantly more shares at the eventual recovery point than an investor who contributed only when the market was rising or who paused contributions during the decline period. The mathematics of this, buying more shares when they are cheaper, earning returns on those additional shares when prices recover, is powerful and completely accessible to any investor who has the behavioral capacity to maintain contributions during market weakness. Which brings us back to behavior, which always brings us back to behavior, because the mathematics are straightforward and the behavior is where the actual challenge lies. The narrative environment that surrounds financial markets makes behavioral discipline almost impossibly difficult to maintain without deliberate effort, because the narrative environment is designed to create urgency, to convince participants that the current moment is uniquely important, that something is happening right now that requires attention and response. Financial news is a continuous stream of information framed as actionable, not as background context for long-term decisions, but as immediate inputs for immediate decisions. A company reports earnings. An economic indicator comes in above or below expectations. A central bank makes a statement. A geopolitical event creates uncertainty. Each of these is presented as something the investor needs to respond to, needs to evaluate, needs to incorporate into a decision about whether to buy or sell or hold or shift allocation. The implicit premise of financial news is that the information it delivers changes what an investor should do right now. For a long-term investor with a diversified portfolio, the correct response to the vast majority of financial news is to do nothing. But doing nothing while being presented with a continuous stream of information framed as urgently relevant requires actively resisting the pull of that framing, which is not the default response and requires conscious effort to maintain. The practical implication is that the amount of financial media consumed by a long-term investor should be inversely proportional to the time they spend reacting to it. Reading broadly to understand how economies work, how businesses create value, how market cycles behave historically, this is useful background knowledge that builds the conviction required to maintain a long-term strategy through difficult periods. Monitoring quarterly earnings, following daily price movements, reading commentary about short-term market direction, and engaging with the prediction industry that produces constant forecasts about where markets are going in the next 6 or 12 months. This produces anxiety, the illusion of actionable information, and the temptation to make decisions that feel productive and are in fact destructive. The research on financial forecasting is consistent. Market direction over short and medium time horizons is not reliably predictable by any analyst, economist, or strategy, and the confident tone in which predictions are delivered bears no relationship to the accuracy with which they are fulfilled. Filtering the useful signal from the constant noise is a skill, and the default for most people, absent deliberate effort to develop that filter, is to treat all of it as signal. The question of what to actually own in a long-term portfolio is important, and the answer is considerably simpler than the investment industry's commercial interests would suggest. The core of a long-term wealth-building portfolio can be built with 2 or 3 broadly diversified index funds, one covering the domestic equity market, one covering international equity markets, and potentially one covering the bond market in a proportion that reflects the investor's time horizon and risk tolerance. These instruments provide ownership in thousands of businesses across dozens of countries and industries, at a cost that is a small fraction of what active management charges, with automatic rebalancing through the index construction process that adjusts exposure over time as market values change. There is no analytical skill required to implement this approach. There is no research process, no stock selection, no timing decision. The only decision is how much to contribute and when, and the answer to when is regularly and automatically, regardless of market conditions. The objection to this approach is almost always the same: it produces average returns, not exceptional ones. It captures the market return, minus costs, and the market return is what the market provides, not what exceptional active management can provide. This objection misunderstands what average means in the context of market returns. Average market returns, compounded over long periods, produce extraordinary absolute wealth. The historical annualized return of broad equity indices over long periods, before inflation, has been in the range of 9 to 10% in developed markets. At that rate, capital doubles roughly every 7 to 8 years. Over 30 or 40 years, even modest regular contributions produce portfolio values that exceed what most people would intuitively estimate. And the average return, captured consistently and without behavioral interference, is achievable by almost any investor who structures their approach correctly. The exceptional active management return is available to essentially nobody over long periods because the evidence that active management produces consistent long-term outperformance after costs and taxes is essentially non-existent. There is a version of this approach that incorporates individual stock selection for investors who are genuinely interested in understanding specific businesses and who find the process intellectually engaging rather than merely speculative. The key is that individual stock selection in this context is not an attempt to time the market or to predict short-term price movements. It is the identification of quality businesses whose competitive advantages are durable and clearly understandable, purchased at prices that reflect a margin of safety against the inevitability of analytical error, and held for the long periods required for the underlying business value to be reflected in the price. This approach requires genuine analytical work, genuine patience, and genuine behavioral discipline, the willingness to hold a position through periods of price weakness when the underlying business thesis has not changed, and the willingness to sell when the thesis has changed regardless of where the price is relative to the purchase price. Done correctly, over a sufficient time horizon, individual stock selection of high-quality businesses can modestly enhance the returns available from pure index investing. Done incorrectly, with excessive trading, inadequate diversification, or thesis driven by price momentum rather than business quality, it destroys returns at a rate that individual investors consistently underestimate because the losses are attributed to bad luck rather than bad process. The deeper truth underneath all of this, the part that is hardest to accept and that functions as the real secret beneath the surface secret, is that successful long-term investing is not primarily a financial skill. It is a psychological one. The financial knowledge required is genuinely not complex. Understanding what a business is, how to roughly estimate whether a price is reasonable, how diversification manages risk, how compounding works over time, these concepts are accessible to any reasonably educated person who chooses to engage with them seriously. None of it requires advanced mathematics, specialized training, or years of professional experience. What requires years of experience and deliberate cultivation is the behavioral capacity to maintain a sound approach through the full range of market conditions that time will produce, through the euphoria of bull markets where everything seems to be working, and the temptation is to take more risk because risk feels like it has been eliminated, through the despair of serious declines where everything seems to be breaking, and the temptation is to exit before things get worse, through the long, boring periods of sideways markets where nothing seems to be happening and the temptation is to do something, anything, to feel like active participation is occurring. Managing those temptations, not eliminating them, because they cannot be eliminated, but having a framework that creates enough distance between the impulse and the action to allow the rational self to evaluate the impulse before acting on it, is where the real work of long-term investing lies. That framework is built from several components. A written investment policy that defines what the approach is, why it was chosen, and what would constitute a legitimate reason to change it. A process for regular contribution that is automated rather than discretionary, removing the decision of whether to invest this month from the emotional state of this month's market. A defined asset allocation with rebalancing rules that are triggered by threshold movements rather than market forecasts, so that rebalancing happens mechanically when allocations drift beyond their target ranges rather than based on judgment about where markets are going. A deliberate reduction in the frequency with which the portfolio is reviewed, because the research on investor behavior shows that less frequent monitoring produces better decisions, not because the investor is less informed, but because the reduced monitoring means fewer emotional reactions to short-term fluctuations that have no bearing on long-term outcomes, and a clear articulation, revisited periodically, of what the capital is actually for, what goal it is serving, what time horizon it is operating on, and what a successful outcome looks like. Because that clarity is the foundation of the patience required to let the strategy work across the time horizon it requires. The stock market secret that nobody tells you is that the most powerful investment strategy ever demonstrated by evidence and by historical experience is also the most boring, the most unglamorous, the most resistant to narrative, and the most psychologically challenging to maintain precisely, because it looks so easy in theory and creates such relentless temptation to improve upon it in practice. It does not require finding the next great company before anyone else does. It does not require predicting market movements or understanding central bank policy or correctly anticipating economic cycles. It requires owning a diversified collection of quality businesses, contributing to that collection consistently over time, managing costs and taxes carefully, and refusing to let the continuous noise of the market narrative override the quiet mathematics of compounding that is working in the background of every day the portfolio is left alone to do what it does. That is the whole thing. The reason it functions as a secret is that the whole thing, stated plainly, generates no revenue for an industry that needs activity to survive, satisfies no need for intellectual stimulation in a culture that equates complexity with sophistication, and fulfills no desire for the exciting narrative of beating the market in a world that celebrates exceptional outcomes over reliable ones. But the evidence for it is overwhelming. The mechanism behind it is mathematically sound, and the investors who have genuinely internalized it and acted on it across full market cycles have consistently accumulated more wealth than those who pursued every alternative that promised something more interesting. The secret has always been available. What has always been scarce is the willingness to accept it and act on it anyway, for long enough to see what it actually produces.